Well, it's important because we see that there's more risk in the market than most investors anticipate, especially after many, many years of positive things. So given that, and given that quality does endure throughout a cycle, to us, centering a portfolio on this idea of flexibility, durability, all of those concepts that would get you through a tough patch, that all makes sense. But also remember that quality also can mean growth, and with growth comes return. So to us, a portfolio centered on quality should outperform over time and do so with less risk.
But what does quality mean in terms of stocks? And give me some examples of stocks that you like right now that exhibit those attributes of quality that you're talking about. What are the attributes,
Sure.
and then what are the examples?
Yeah. So quality means lots of things to different people, but to Washington Crossing, what it means is looking at an entire firm, the entire capital structure, debt, equity, the whole thing. We want to see low debt. We want to see a very consistent business, and we want to see highly productive assets. And if we can't see those three things, then we consider a firm to be of low quality. But for us, high quality firms would be companies like TJX companies, for example, or Honeywell, for example, or Canadian National Railroad. Those are all names that to us, by the way, they've all underperformed this year, which we think sets the stage for better returns in the world ahead. Mm-hmm. But they're also companies that you can count on, in our view, when things get rough and investors start to look for that kind of durability and flexibility.
Kevin, what do you make of the broader call as to whether we've reached kind of bottom here and we're turning around? I mean, in other words, is the dip behind us now?
Well, the market is trading with in the United States with a value of over $50 trillion, sitting on a $22 trillion economy. So the challenge for us is not so much about the dip, and it's not like we're going in buying lots of cheap assets. In fact, what we're seeing in our macro work is that the expected returns for stocks are in our view, the lowest we've seen in a very long time. And the only real problem is that we're coming at this with the market trading at a 37 multiple of normalized earnings. That's higher than average. And those valuations at some point are going to impart a cost. So to us, it's not so much that we see a trading bounce or anything here. What we're really saying is that for a long-term investor, we want to be able to focus on areas of growth and durability and recognize risk, because there is risk in the market due to more debt and due to high valuations. So we want to focus on this quality concept.